YieldMax funds have been a hot topic in 2025, with ETFs like MSTY and ULTY exploding in popularity thanks to high distribution yields. But are these high payouts too good to be true, or the future of dividend investing? Let's take a closer look. Let's start things off with MSTY. This is one of the more popular YieldMax ETFs, and a big reason for that is its high distribution rate. This currently sits above 90%. So how does this fund actually work? MSTY generates monthly income by writing and selling call options based on the company MicroStrategy. So that company drives the performance. Now, if you're not familiar with MicroStrategy, they were originally a traditional tech company in business since the early 2000s, but in 2020 they made headlines by switching a large portion of their cash reserves into Bitcoin. Ever since, the stock has become highly volatile, and that volatility is exactly what makes it attractive for this kind of income generating option strategy. Now, one thing you might notice about this fund is that it doesn't directly invest in MicroStrategy. So how does that work? MSTY uses a strategy called synthetic covered calls, meaning that it trades options that are based on MicroStrategy's stock price movements. So while it's tied to MicroStrategy's performance, the fund does not actually own any of its shares. It just mirrors the price action through something called derivatives. Now, earlier I mentioned that MSTY's distribution rate is sitting around 90%, but here's the thing, that number is not fixed, and it's definitely not guaranteed. It's based on the last 12 months of payouts, and it can swing dramatically depending on market conditions. For example, when I last covered MSTY, the figure on their website was showing about 140%. Just 1 month later, it dropped to 92%. That's the nature of these high-risk dividend funds. They're tied to volatility, not consistency. Now let's talk about something that often gets overlooked with YieldMax funds: NAV erosion. NAV stands for net asset value, and it's basically the share price of the ETF. Over time, some high-yield funds can see their NAV gradually decline, and that's exactly what we've seen with MSTY. Why does this happen? Well, because the fund is aggressively paying out income through its option strategies, there's less money staying inside the fund to support long-term growth. For example, over the past year, MSTY has traded as high as $46.50 and as low as $17.10. As of now, it's sitting around $20 per share. That's a lot of volatility, and a clear example of how high distributions don't necessarily mean you'll preserve your principal. In fact, if you look at the 1-year chart, MSTY is down about 25% in the share price. But since its launch in early 2024, the total drop from inception is only around 5%. Now, what would have happened if you invested $10,000 into MSTY when it first launched in February 2024? At the time, the share price was around $21.19, and fast forward about 1 year and 4 months to June 2025, that investment would have grown to approximately $38,000 if you had invested all dividends back into the fund. That's a total return around 282%, or an average annual return of over 173%. But even if you didn't reinvest anything and just collected the payouts, your $10,000 would have grown to about $27,000, and that includes roughly $18,000 in dividends collected, plus the remaining value of your shares. So even without reinvesting, you'd be looking at a total return of about 178%, all from monthly income and options-driven performance. Let's take a look at ULTY, another YieldMax fund that takes a more diversified approach and has recently shifted to weekly payouts. This is YieldMax's Ultra Income Strategy ETF, and like MSTY, this fund uses a synthetic covered call strategy to generate income. But instead of focusing on just one company, ULTY takes a much more diversified and active approach. The goal is to generate weekly income, which is different from most of the other YieldMax funds that tend to pay monthly. We'll talk more about that payout structure in just a minute. What makes ULTY interesting is that it doesn't track a single stock. Instead, it's built on a basket of 15 to 30 different companies based on their implied volatility. Some of those names include Reddit, Circle Internet Group, Robinhood, AST Space Mobile, and Tesla. So it's a mix of well-known growth plays and high volatility upstarts. As of March 2025, ULTY switched from monthly to weekly payouts, which is pretty rare in the ETF world. This can be especially appealing to income-focused investors who want consistent cash flow, whether that's for reinvestment or for spending. But how much are we actually talking? Similar to MSTY, the distribution yield on ULTY is pretty eye-catching. It currently sits around 70%. Now keep in mind, these yields are not fixed. They're based on that last 12 months of payouts, and they can shift dramatically depending on market conditions. Now let's take a closer look at ULTY's dividend payouts. Since switching to weekly distributions, payouts have been ranging from 8 cents to 12 cents per share, and they've remained fairly consistent throughout 2025. But the next question is, how has this impacted the share price? Well, since the switch to weekly payouts, ULTY has been hovering around the $6 mark. Back when it was paying monthly, the share price was on a steady decline. But as of March 2025, things appear to have stabilized under this new structure, which may signal YieldMax's more active approach, and weekly income model is helping smooth out the volatility. Now let's take a look at what could have happened if you invested $10,000 into ULTY back when it first launched in February 2024. We've got two charts here. The top one shows the total return with dividends reinvested, and in that scenario, your position would have grown by about 8.9% or $890. But if you had taken the dividends out as income rather than reinvesting, the position would actually be slightly in the red, down about 0.18%. Now keep in mind that this is before the fund switched to weekly dividends, and while we only have a few months of data since that change, here's what it looks like so far. Using that same $10,000 investment, if you had bought around March 2025, reinvesting the dividends, your return would have been about 15%. Without reinvesting, you'd still be up around 10.9%. So this new strategy has been performing well so far, but we'll need more time and data to see how consistent it really is. At the end of the day, both of these funds are high risk, high yield plays that serve different types of investors. Just make sure you understand what you're getting into. These are income machines, not long-term growth ETFs. If you found this video helpful, make sure to like it and subscribe for more ETF comparisons. Let me know what you think in the comments below.